Explain how that happened, because we were talking in the last hour how it appears that Credit Suisse and Nomura got caught to some degree flat-footed, even though Credit Suisse and Morgan Stanley appeared to call the default on Archegos at the same time. Why?
Hey, Andrew, nice to be with you. I think this is a case where being slow to act is the same as being wrong. So the street had $30 billion worth of stock to try to unload starting Friday. Morgan Stanley and Goldman Sachs were the first to do so. Goldman Sachs actually unloading $10.5 billion on Friday alone. And this is something that they transmitted to their clients. And so, I mean, I think this is just a case where everybody's heading for the exits. Risk management, prudent risk management dictates that you act fast.
So, Bethany, we've seen, I feel like we've seen this movie now a couple of times together over the years. And the question is, what should regulators be doing about it? The SEC calling a meeting to discuss it.
Well, I was just going to say some things never change, right? And as much as Goldman has changed over the years, here's an instance in which they haven't changed. And so Goldman was well collateralized, unlike some of its peers involved in this. And you also saw a desperation at the top of the market on the part of firms like Nomura and Credit Suisse that don't know what they're doing in the prime brokerage business as much as Goldman and Morgan Stanley, and were desperate to get in and probably didn't ask for the same degree of visibility into the positions that Goldman and Morgan did, and certainly didn't ask for the same degree of collateralization. So, but I do think even if the fallout from this seems to be somewhat contained at this moment, it does, when you look at the complexity of some of the financial instruments that were involved here, like these contract for differences that really aren't that well understood. And the fact that all these years later, prime brokerages still don't have that much insight or visibility into what a big firm could be doing across all of its PB relationships. And this firm was unique in the extent of those relationships. You wonder, Lehman London, long-term capital management, has anything really changed? Are the regulators on top of it?
Okay, jump ball for both of you. I'm curious where you land on this. We were talking about this just in the last hour. Morgan Stanley acted as the underwriter to the Viacom offering, this $3 billion offering, which appears to have exposed some of the problems with just where the market was on Viacom and therefore Discovery, and put pressure on Bill Hwang's firm. Yet, of course, Morgan Stanley also was dealing pretty much at the same time with some of the problems at Bill Hwang's firm. Should have they known? Were they conflicted? Did they give either bad advice to Viacom or bad advice to Bill Hwang? Bethany?
I think they'd probably say, what was the old Goldman line? If there's no conflict, there's no interest. I think they'd probably say that it was different parts of the firm, and that it would have been a conflict of interest to have disclosed either one, but it sure kicked off a mess.
Hugh?
Hey, Andrew, look, as others have reported, and I'm about to update my story with, the primes got together on Thursday, right? So they got together earlier before this forced fire sale got, spilled out into the public view. People knew that this was an issue. So it is really hard to understand why Nomura and why Credit Suisse sat on their hands. And by the time they put out those releases on Monday morning before the start of trading, that they would have material losses. And, in the case of Nomura, up to $2 billion in losses, Morgan Stanley and Goldman Sachs had already been out. So I don't think you could claim that, that they had this unfair head start. On Thursday before the sales, people were aware of the situation and they decided to act or not act in some cases.
Shepard Smith here. Thanks for watching CNBC on YouTube.